Good, almost noon from Rye, New York. Soon I will be doing this from New York and not just from Rye, from our offices in New York City. So happy to have you all here. And soon I'll introduce my friend here, Ron. And this is a different kind of session. So those of you who know what I do, what we're doing in the online sessions, know that we're doing mainly sessions where I interview either thought leaders, family offices, high net worth, and interesting investment opportunities. And our audience are the family offices. This time around, it's something completely different, like Monty Python love to say, where I actually thought, you know what, maybe it's about time I will share with the world a little bit of my experience seeing hundreds of conferences we've been putting on how to reach the family offices, mistakes people do, funds do, follow-ups, and all of that. And then I thought, you know what, I would like to, we'll see how it goes. We have a lot of points, so probably it's going to be a series of sessions and not just one. But I will also bring some interesting guests that work closely with the high net worth and hear what they have to say as well. And then when I thought who would be my first guest, that, by the way, has no idea what's going to happen today. Ron doesn't know what I'm going to talk about, we didn't prepare anything, and that's the beauty of it. So soon you'll see how that goes. So when I thought who would be my first guest, so as you probably don't know, and this is a topic for another session, how do you even find the right platforms for family offices? Because today, unfortunately, in the world of family office, it's a little bit of an elusive term, right? Family office, because when we do institutional investment conference, either the guy or the lady has a card that says pension fund manager, right? There's no way around it. But family office is very flexible. I can tell you, oh, this guy manages a lot of money, this lady has this and that. And how would you prove that? How would you know? And what happens is many groups title themselves family office this, family office that. Most of them are people that maybe have a family and also an office, but that's as close as they get to family offices. And that's a problem that I can address at a different session. How do you even find, and I'm not saying we are so amazing, I'm just saying you need to know how to find the groups that are real from those who aren't. And unfortunately, those who aren't are many, and this is a mistake. A lot of groups that don't come from our space do. When you look at UBS or PwC, they know how to navigate our space. Problem is VCs, startups, companies coming from a different world don't, and that's a different topic I'll talk about in a second. So first of all, I'll say a couple of words about my guest today. Then I'll introduce myself. I'm sure many of you don't know who I am. And I will start giving you some ideas that I think people should be aware of. Because, by the way, when I looked at those who explain how to reach family offices, if there's anything like it, it's mostly those are trade organizations that do this for their members. I never heard the real families talk about it and tell you this is how it works, or people that work closely with them like myself or Ron. So before I introduce myself, I'll introduce Ron. When I build my conferences, and this is another thing that I think distinguishes us, and as an ex-journalist, I do research of the town I'm going to. Who are the right people that needs to be involved? I want somebody who understands real estate. I want another person that comes from tech. I want philanthropy. I'm building a steering committee that's really top people in different sectors that the only common ground they have is high net worth individuals. And one of those names that came again and again was Ron Diamond. And that's how I got to know Ron. And then I said, okay, Ron Diamond is the guy in Chicago I need to talk to, then let's make it happen. So let me tell you, Ron is a longtime investor and entrepreneur and the founder and chairman of Diamond Wealth, represents 100 single family offices ranging in size from $250 to $30 billion and invests alongside his clients, mainly in private equity, real estate, venture capital, and special situations. Ron is the director of the Global Family Office Initiative at Stanford University, as well as serving as chairman of the advisory board of Stanford University's Digital Cities program. He's an adjunct professor at Stanford, and he's the chair, and this is basically how I know him as well from another direction, of two Tiger 21 groups in Chicago. For those of you who don't know, Tiger 21 is probably one of the most important, if not the most important group of high net worth that meet. They have chapters all around the US, Canada, and discuss different issues that, otherwise it's pretty lonely at the top. It's a group that we've been working with in different ways. And their founder spoke at my conferences several times. And is the national chair of the family office group at Tiger 21. Is also the host of a podcast on family offices, family office worldpodcast.com. And this is just to give you a little bit about Ron. So first of all, Ron, how are you doing? How is Chicago today?
I'm terrific, and thank you very much for having me, Denny.
Thank you for being my guest at this very special session where I finally interview mainly myself. So let me tell you a little bit about me. I'm, as I told you, I'm an ex-journalist. It's funny, I just spoke to the CFO of Enron lately, and I was the one writing about Enron when people didn't even know what I was talking about in Israel. I started doing financial conferences that we still do in Israel, institutional investment, corporate finance, and all of that. And what we've been doing since was learning about the world of family office. And I did the first conference 11 years ago and basically hooked up with two next gens of Israel's most prominent families and learned what they care about. Philanthropy, next generation, co-investing, depression, marrying into wealth, suicides, real estate, technology, you name it, everything that's on their scope. And that's how we built the first event in Tel Aviv 11 years ago. Up till then, the families could have gone to see a UBS conference or Credit Suisse, which would for sure would get them the best food in town, but you're going to hear what the bank wants you to hear. And it's not always what you want to hear. You want a neutral scope. Then we came to the US. We thought, okay, how are we going to compete in New York? Even in Israel, we come from a city called Yehud, which most people in Israel don't know. So we said, okay, we have to have some strong edges. And then we thought, wait a minute, we're the only group that comes from Israel. That means we have some edges, like, for instance, our reach to the ultra high net worth Jewish community around the world. Having said that, there's no one community over another at our events, but that definitely gave us something interesting, speakers that I think are interesting in families. Technology, we come from Startup Nation. Most families love to hear about technology. So what we've done is every conference we do, and those events are held at the main cities of the world, opens with a tech session. And we have a sub-conference dedicated to technology and innovation, and another one to real estate that we're doing with and at the premises of the world's leading legal firms, like Baker McKenzie in London, Sherman & Sterling, Herrick Feinstein and others here in New York, Reed Smith, and Fasken, Steichman and others in Canada. We are today in Chicago. Next year is our first conference, and Ron hopefully will be very much involved with that. New York, Miami, Houston, Dallas, Toronto, Vancouver, Montreal, Tel Aviv, London, and soon the UAE. And we are known for our amazing speakers: Spielberg, Silverstein, Arison, Bronfman, Rockefeller, Bush, Mars, Samzel, etc. Loads of great names. We're doing conferences, we're doing online, we're doing private dinners, and we're doing online sessions like you see here. And when COVID started, I really thought, if COVID will not get you, just watch some of the webinars out there, that will get the job done, because everybody are doing online sessions and it became horrible. So what we've done differently, I think, is taking my journalistic maybe experience and interviewing families. So I've had families from all around the world, India to UK, from Scaramucci and Katsimatidis to Arison and Spielberg. And we've been doing, I think, almost over 200 by now. Anyway, that gave us a lot of experience throughout the years to see how funds or others approach the family office world, the mistakes they do, and this is a little bit of what I want to talk about today. And by the way, I'm assuming you understand why family offices are important, but that's a different example, a different session, maybe why you should go after the family office space. We can talk about it at a different time, but maybe Ron, you just wrote in your post, and this is something I would like you to mention, how vast the family office world is already and about to become. You mentioned it's going to be, you mentioned some figures. Can you tell me, and the fact there are patient capital, so maybe just a couple of words about why you think this world is so important.
Well, the family office market is soon going to be larger than the entire private equity and venture capital markets combined. So you have and again, there's no specific statistics, but there's roughly 17,000 family offices throughout the world, roughly. Um, Remember though, of those, 68% started since 2000, and half of those started since the crash. So this is a relatively new phenomenon. Family office has been here since the Rockefellers, I mean, even before them, but this is a new phenomenon as far as how much they're doing. I actually gave a speech at Stanford, a keynote, and I had five billion-dollar families on the panel, and I just asked a very simple question. I said, what is a family office and why did you start it? And I got five completely different answers. And nobody was wrong and nobody was right, but it just shows you where this industry is. So you've got a $10 trillion industry. You've got $65 trillion coming down from baby boomers to the next gen in the next 15 years, which will be the largest transfer of wealth ever. So this market's going to get bigger and bigger. The problem is that the industry in general is fragmented, siloed, inefficient, and non-collaborative. And that's what we're trying to do at Stanford, where I'll be the director, is put together a center to help family offices network and be more collaborative.
Thank you. And what Ron mentions doesn't even include another group of people that I find to be as important. I have this theory that I've developed basically on last Tuesday that goes like this. This is how I look at the family office and high net worth. Many people, Ron, as I'm sure you'd agree, high net worth individuals that had a liquidity event, for instance, that are very interesting and strategic to everybody, which we need to know how to address as well. Some of them don't even know yet they need a family office. They're not at that stage yet. When I look at the wealth, and this is maybe my first point, you need to understand who you're talking to and understand these are different animals, if you will, okay? So we got the traditional wealth. And Ron, I would love to hear what you think about it. Basically, I developed it last Tuesday. So there's the traditional wealth. And that's what Ron is talking about. Families like Rockefeller and others that have different generations. They have some of them, not all of them, by the way. I think in Israel, in some places around the world, they don't yet build a family office infrastructure. They just have a legal guy and an accounting firm, but nothing really built. So that's what I call the traditional one. Then you got the corporate wealth. Corporate 500 folks working there, earning their money, and they make, now please note that those that come from multi-generation, they already know how to deal with wealth. They already built it for generations. Most of them are prepared. It's nothing new to them. Corporate is becoming wealthy every single year, so it's gradually being built, but it's still first generation. And then you got entrepreneurial wealth, which I will also put into two different categories. So one, and by that I mean three categories. One is everybody who had a liquidity event, right? So you got family businesses, they sold the business, first generation, they had a liquidity event, suddenly they are very wealthy. And then you got the technology wealth. And by the way, the tech wealth is completely different than everything else. How many entrepreneurs do you know? And you know, sometimes when I go to a Tiger meeting, I'll tell you, Ron, I see some people that are very comfortable. They had their wealth, they go to the yacht club, they play golf, which is completely fine. But I don't know how many of you met the tech entrepreneurs. These guys do not stop. If they finish their first exit, they're working on the next and working on the next, opening a fund, whatever it is, these guys don't stop. And I've seen it in so many instances. I think there was one young person in Israel I met, he was the only one that retired, but otherwise they don't stop. And that means that's a different kind of wealth, by the way, new wealth. So when you talk to them, it's a little bit of a different discussion. And even in the tech world, I will divide it to the traditional tech, those that went to the right schools and went in the right path. And some may disagree with me, but I don't care because I'm running the show, blockchain and crypto and all of that world. And I had a session where I had one of the major names from the crypto world with one of the major names from technology, where we had a private Zoom call, and you saw the differences. You saw this guy is here, this guy is there, and they don't really mix. If you speak to a blockchain person, half of the people will give you are from that world and not the tech world. And think about it if they could work together and invest. But anyway, that's a different point for a different session. That's how I look at wealth. So I think first thing you need to understand is you're talking to different people in different ways, and I can elaborate later on that. Anything you have to say about that, Ron? Would you agree with what I just described? Would you? And again, guys, people, Ron has no idea what I'm bringing. I'm surprising him as we speak.
Yeah. So no, you raised some really good points. I think one of the interesting things that people don't fully understand is that the family office model doesn't work. I mean, only 25% of family offices make it to the second generation. 10 make it to the third, and 5 make it to the fourth. So everyone now wants to be a family office, but the model doesn't work. So that's what we're trying to solve for. And a lot of the reason has nothing to do with creating alpha, because there's a lot of people who are good at investments in real estate and private equity and venture capital. A lot of it has to do with the soft skills: governance, succession planning, next gen, education, philanthropy. And those are things that are really important. And the last thing I will tell you is, when I'm asked, how much money does somebody need to have a family office? Well, first of all, you can do whatever you want. It's your own money. But I've done the math. And if you're going to invest in the private market, meaning private equity, venture capital, real estate, doing direct deals, you really need about $500 million in order for it to make economic sense to have a complete, fully served single family office. Short of that, your best bet in many instances is to work with a multifamily office, and that's where they were created. So a lot of the family offices do have less than 500 million, are doing direct investments. The problem is that post-crash, pre-COVID, all these direct investments, or most of them, worked because the private equity market went up, the real estate market went up, Bitcoin went up, the stock market went up, whatever you invested in. So a lot of these families that did these direct investments because they didn't want to pay the 220 fees are going to be way over their skis when we head into a recession, because there is a skill set into doing this. So my thought is how I think how this will play out. A lot of these single family offices are going to realize that they need additional help, and some of them will morph into multifamily offices. And the family offices that are large enough and sophisticated enough, they're going to share best practices, because if they want to compete directly with Carlyle or Apollo, you need to attract the talent. You need to pay for that talent. And I do believe that as private equity and venture capital disrupted the public markets in the early 80s, family offices are starting to and will continue to disrupt venture capital and private equity going forward. It'll never replace it, but it'll disrupt it, because it's a better alignment of interest, and private equity and venture capital, in truth, has become a lot of an AUM game.
Thank you. Now, many funds here and groups that are joining the session want to know what we've learned from our experience about the do's and don'ts, and this is where I'm getting to right now. Before that, I will tell you something else. Ron talks about the family office world, and for the funds and everybody who's raising capital, really, the high net worth are as, and sometimes even more important. First of all, there are many, as I said, that do not have a family office. They do their own investments. And what's interesting, and I like to call it, there's a term called passion investment, right? Which means basically that you invest in something that doesn't make sense, but you don't care because you love it. You're passionate about it, right? It can be Broadway. It could be films. It could be art. Your advisor will tell you, no, it's not worth it, but it is for them because they're emotional about it and it excites them. And here is just one point I want to make before I'll dive into details that you don't have with family offices, you don't have with institutional investors, you do have with the family members, okay? Let's say that I'm a tech company that does 3D whatever, right? Glasses. And you're, and the family office of that specific family were told to do cyber technology, okay? There's no way they're going to talk to you, right? There's no way. You go to the professionals, they were told what to do, and you're not in that pie. But now imagine that I'll go to the family member themselves. Let's say I meet Larry Silverstein, and I say, Larry, listen, I know you don't do that. I know that. Would you do me a favor and put those glasses on for just a second and give me a chance to show you what I do? So, okay, let's do it. Now, if he falls in love with that, that's it. He's going to come to his person, to his professional manager, and tell him, I want you to check these guys out. I want you to find the right person that can do the due diligence. I think this is going to happen. So my point is, the only people on earth that can be persuaded to do anything really are the family members in the right context, of course. Everybody else, institutional investors, family offices, they have, and rightly so, they have a strategy. They were told in which areas to work. What I'm trying to say here is that you really have a lot of opportunities you don't have with others when you work with the family members and get them excited. The wife, the husband, the parent, the daughter, the dog walker. Ron, what do you think about that?
Well, I think that, it's interesting because with family offices, the first, second, and third thing a family office is going to want to know before they work with you or with anybody is, can they trust you? And the fourth and fifth thing is, what's your track record and, what's your background? That's flipped on an institutional side and the pension side. So they're going to want to know what's your 3-year, 5-year, 10-year track record, what's your biggest drawdown. They want to know the facts. Family offices, again, certainly want to know the facts, but before they will consider working with somebody, they have to feel comfortable with it. And remember that why was there such a surge in the growth of family offices since the crash? If 68% of family offices started since 2000 and half of those started since the crash, what was the impetus? And the impetus was trust. Many family offices lost trust in Wall Street. A specific example would be, a lot of people had money in hedge funds. And then all of a sudden, when the crash came, hedge fund put up gates. A lot of these people didn't know what gates were. Gates, basically, you can't sell. So what happened is you've got $10 trillion in capital, but in general, and again, I'm generalizing, it's in inefficient hands. It's the people who created 5 Hour Energy or Beanie Babies or Guess Jeans or Giorgio Perfume or a chain of gas stations, and they come into a liquidity event. It's a completely different skill set to build a company like they did than to take $1 billion, grow it to 2, not spoil the kids, do some wealth transfer, do some philanthropy, do some impact investing, and grow the assets. So there's a big mismatch right now. So a lot of the people, and what a lot of the families will do is, they will bring over their, the person who ran their portfolio company, they'll bring over the CFO. He was the numbers guy. Well, there's a different skill set to doing private equity than being a CFO of a company. So right now, that's why there's so much inefficiency. And I do believe that as family offices begin to collaborate more and work closer together, and we come together much more as a community, this is a game changer, because at the end of the day, the biggest advantage that we have, that family offices have, is patient capital. And that goes back to what I first said about alignment of interest. Patient capital is the single biggest advantage that family offices have over venture capital and private equity. Because at the end of the day, if you're a smart entrepreneur coming out of Stanford or Harvard or Wharton or wherever, and you've got a great idea, you try to go into NEA or Sequoia or one of these big venture capital funds. That's really not the best model, because what happens is once you're there, you're one of 20 portfolio companies, and your fate is determined by when that venture capital firm wants to sell you. And when they want to sell you might not necessarily be the best time to sell your company, but it might be the best time for them to sell for their company. So they get compensated to turn money over every 3 to 5 years, which is fine. That's just the model. But what if you have a company that's doing really well? It's taking 3 years to get off the ground, and then you're just looks like it's going to rocket ship up. Family offices can hold it for 10, 15, 20 years. And if you do the math, and if you look at the companies, the private equity firms or venture capital funds or companies that have been bought and sold by these different funds 3-5 years every time for 20 years, and you look at the cost, the friction of the transaction cost, the taxes, versus a family office who could own that one company one time with no transactions, no taxes, no friction, it's like compound interest, it's a better model. The problem is that family offices, we need to do a much better job educating the public on what we do, how we do it, and why, in many instances, it's a superior model. If you're looking to flip your company for the highest dollar amount, never go to a family office, because you'll always get private equity or venture capital funds that'll pay for that and overpay for that. But if you're looking for legacy, if you're looking for this family off this company that you've created and it's your baby to last 2, 3, 4 generations, and you really care about all the employees, in most instances, I would argue that you're better off working with a family office because of the patient capital and because of the strategic capital. And they don't have the artificial timeline to flip these companies every 3 to 5 years, which in some instances works, but in most instances, it's just an artificial timeline on how they're compensated.
And I will say something else, and then I'll start diving into a couple of points, is that interesting about family offices. First of all, I think they're very fast to react when they need to, right? When you look at every important trend, cannabis, blockchain, opportunity zone, the first ones to check it out, understand what's right or wrong, were they, right? By the time the institutional investors get it, the trend is over. That's one thing. Second thing is they will give, I believe, a shot to folks that others will not give them a shot. So if I'm a first-time fund, I'm not ticking any box that the institutional want you to tick. What do you mean first-time fund? We don't talk to first-time funds. When you get 3-4 years of track record, call us, right? But when I brought, it's a great example. I brought this fund from Israel, first-time fund in agrotech. I mean, how low can you go? I mean, it's suicide, right? But the guy's father built one of Israel's largest publicly traded agro companies. And you're saying to yourself, wait a minute. So he's got a reputation to keep. He's not under pressure to make more money. He's good. He understands agro-tech from the days 4 years, he's 4. And he's got to love it if he's still doing it. It's his passion. Do I bet on that horse to get me to places? Is he more hungry than other funds that are, too big or too this? If I'm a company that does something a little bit off, that doesn't tick the boxes of some other investors, that's where you go to. I think the families would hear you. And like Ron says, trust. I don't think if they'll see a too overkill marketing Wall Street guy, hey, that will be all over them. I think they'll lose them very, very fast. They want the trust issue and a good idea. And I think they'll be willing to take a chance. Would you agree, Ron, with what I just...
Yeah, I would definitely agree with it. And again, we're only in the second inning of family offices. I mean, this is still a very, very new phenomenon. And where we are now versus where we'll be in 5-7 years is a lot different. One of the things that we need to do is, first of all, to attract talent. So how do you attract talent? So right now, the way I would look at it is, if a family office, and again, I'm generalizing, but if a family office hires a kid out of Stanford or Harvard and they're paying them $250,000 a year because they're going to do well, they hope, in general, they look at that person as a cost. In other words, you cost me $250,000. If Carlyle or Blackstone or Sequoia hires this kid out of Stanford or Harvard and pays them $250,000, they look at this as, it's cost $250,000, but they could be a $10 million profit center. It's nuanced in its optics, but if you look at it as a cost, you're not going to be able to compete with the Carlyles and Apollos. So you look at some of the sophisticated family offices like that we work with, like the Pritzkers, the Dells, the Crown, et cetera. They incent the people. You have to incent the people, or you're not going to get the top talent. If you do not get the top talent, you're not going to be able to compete directly. Some of the firms have done a phenomenal job, but a very small percentage of them have. So one of the things we need to do is people need to understand that if you want to have a family office that's going to compete with venture capital or private equity, you need the talent. And in order to get the talent, you need to figure out a structure on how to pay them. That's number one. Number two, I think that family offices, the other thing that they offer, in addition to patient capital, which is by far the biggest advantage, they offer something called strategic capital. So if you're working with Greg Watson, was the CEO of Walgreens, sold cashed out and started a family office, he's got a tremendous amount of information on anything healthcare, right? He could be a strategic partner. They could introduce you to people. Now, if you look at the private equity and venture capital firms in general, more of them are finance guys. Most of them are financial engineers. Not all, but most. In order to create true alpha, in my opinion, you have to operate. You can't do it through financial engineering. You could definitely make money financial engineering, but true alpha, you need to do it through operations. And if most of the people on the venture capital and private equity side have financial engineers who are trying to flip companies over 3 to 5 years and they're finance guys, that's not the ultimate way to do it. So I think things like this are going to come out more and more. I think you're going to see more and more people realize, oh, family offices, I get it. It is strategic capital. They were once an entrepreneur, because behind every family office was somebody who had an idea or a company or business or concept and scaled it. So they get it and they understand what you're going through. And the problem right now with the private equity and venture capital industry, and again, I'm generalizing, is that if you're that smart guy, you're one of 20 companies and you're just going to be sold whenever it's time for them. And the last thing I would say with family offices is, because of the strategic capital, because of the patient capital they have, a lot of people will always ask me, well, how do you get in the door? There is no, I wish I could give you a silver bullet. There is no silver bullet. All I could tell you is this. And again, what we do, we invest, we've got about 100 families we work with, between 250 million to 30 billion, and we just invest. I invest alongside them, from private equity, venture capital, real estate credit, and I kind of act as a funnel. If they want to come in, great. If they don't want to come in, that's fine too. We don't charge anything, but basically I do it from a selfish standpoint because I can get much better deal flow if I could place 200 million than if I could place 2 million in my own capital. So that's basically why I do it. And family offices right now, they're deliberately under the radar, right? So they try to be secretive. So I can go right now into a book and tell you the top 50 venture capital firms, the 50 real estate firms, the top 50 private equity firms, and they're listed. You can't find that in the family office world. So one of the things we're going to have to do is we're going to have to educate the market on not only why we're better, but basically what we do. And one of the things, the reason I put together the family office initiative at Stanford, I teach at Stanford and I'm on the board there. The reason I put it together is very simple. It's without doing something like this, without having some kind of rails to put this industry together, you're just going to have another, 65 trillion come downstream, and you're just going to have more and more inefficiently run family offices. I do think that once we collaborate, this is a game changer. And like I said, I think you'll be hearing a lot more about the word patient capital, strategic capital going forward. And family offices, we're at an inflection point, and this is a massive, and it's a phenomenal opportunity right now.
Thanks, Ron. So what I'll do now, I'll talk a little bit about the mistakes people do and what you should and shouldn't do from my perspective, and we will not cover everything today. Ron, if you can read the questions while I will talk about it a little bit, because I see there are many questions coming. So first of all, I just had a call today, 2 hours ago, with an Israeli fund that had it so wrong that I was like, didn't know where to start. First of all, they said, oh, we do understand family offices. We have them here. They're investing with us. How did you get these family offices? Oh, we were working with this introducer or, person that brings them to us. There are millions of groups like that do introductions, that raise capital for a success fee. That doesn't mean you know how to work with family offices. That means somebody brought you family offices to your organization. Great. What I'm talking about is how to create the relationship from scratch. And by the way, people don't understand another major thing. It takes time. You don't just go to a conference, to a meeting, you meet somebody, and if they didn't invest with you the next day, it's a mistake. Some families would take a year to due diligence the hell out of you. And I've seen it true, $1 billion Australian family doing due diligence to a real estate firm for a year before they put only $1 million, because it's their money. It's not other people's money, and they take care of it. And even though they're a $1 billion group, some of them would say, let's see what you do with that million, and then we'll talk. So one thing, there's a big difference between, when you develop the relationship with families and somebody bringing them to you. There are many of groups that do that. That's less interesting, I think. And if you develop the relationship, even if you stopped raising for your fund, you have this group, you develop relationship and trust. In a year, it might come, and then you need them. And then you don't start from scratch and you're all stressed. You already have the relationship.
Denny, you raise a really good point, an excellent point. And there was a question on the chat room. how do you build trust? How do you get into these relationships? There again, I wish I could give a silver bullet answer for this, and there's not. But one of the things that families want to know is, are your interests truly aligned, right? So you could argue that, if you're a wirehouse, they're not even fiduciaries, right? So they're, to me, they're going to try to sell products from their own firm, and that's why they're incented. They want to know that your interests are aligned. So I was introduced to about a $5 billion family that just started about a month ago. And he called me up and he wanted to get my ideas on some investments for private equity, for real estate, for venture capital, and he wants to be in the funnel. And what I said to him is, yeah, I'm happy to do that, but that's not the first thing you need. The first thing you need from me is me to introduce you to other family offices, because I can give you advice and many of my ideas will work. Some of my ideas won't work. Hopefully more work than don't, but you need to create a group, a network of other families. So I introduced this family to about 20 other family offices. And he called me back 2 weeks later and he's like, I can't tell you how much I appreciate your introductions to these families. He's like, why did you not give me any ideas? And I was like, because that's not what you need. So we all know intuitively what, at the end of the day, I want them to invest alongside me so I can get better deal flow from a selfish standpoint. But I know what's in their best interest. And what's in their best interest is meeting other families. A lot of times people have a liquidity event and they'll say, all right, Ron, I'm ready to invest with you. I said, no, you're not. What you have to do is the boring stuff. You need to go to an estate planning attorney and you need to structure everything properly, because it's like building the foundation of a house. Your first thing, once you have a liquidity event, is not to make a great investment in venture capital or real estate or private equity. Your first thing is to talk to an estate planning attorney and get everything structured. Without the structure, the investments don't matter. And that's really where it makes a difference. So all I try to do is connect dots and surround myself with people that are best in the world in various areas. And that's all we try to do. But at the end of the day, to get into family offices, another thing somebody asked me, I one time was introduced to a family and then, it was a really interesting family. And I wrote them a letter, afterwards. And they called me 2 weeks later, like, I've never received a handwritten letter in like 2 years. Like, who does that? And it's not that it was prophetic or anything brilliant. It's just that I took, and again, I wasn't even thinking about it. I just took the time to just write a handwritten letter, which people don't receive. Going above and beyond, doing things like that and building trust and showing that you actually do care really make the difference. It's not, yeah, you went to Stanford and you're really smart, and yes, your fund did great and that's terrific. But by the fact that you're going to go above and beyond, whether it's a little thing like writing a letter, finding out things about their company that they might still have an operating company, send them information about the industry that's additive. It has zero to do with any transaction you're going to do with them, but it shows you're thinking about them. And it's not complicated. We all know what to do. So as long as we could look at it from the long game, this is a marathon and not a sprint. And you could show the families, you can't work right away with 100 family offices. I've been doing this for 20 years. You start with a couple, you add a lot of value. Once you've added value to a family office, they're gonna sing your praise, and they're gonna say, you got to meet this guy Denny because he really helped me and I trust him implicitly. That is a much better referral than Denny talking about how great he is at what he does. So it all has to do with taking the extra effort, taking the extra time, and truly showing that you care, because you do. And at the end of the day, if you help people, it does come back in spades.
Thank you. Now, the same conversation with that fund this morning. So the second point they mentioned was they asked how much time can we do a presentation at a conference. I said 20 minutes. They said, oh no, we need an hour to describe what we do. And of course, you don't need an hour to describe what you do. You need to be able to describe what you do in 10 minutes, 20 minutes, an hour, and 2 hours. That brings me to my first point. I had a company presenting in a Miami conference, and half of the people left in the middle of their lecture. and they came to me and said, what the hell? What is this? What is that? I told them, well, you're very lucky they didn't leave after 2 minutes of your lecture, because we don't know what the hell you guys are doing. You need to know when you're presenting, just like when you're writing an email. I tell my employees, when you write an email, I want the first sentence to say, who am I? What do I want from you? And why I'm so exciting and great fit for you that you should keep on reading, right? So same thing when you're presenting your fund, your company, elevator pitch. I don't want to see an elevator pitch of an elevator in a haunted house that was stuck for 2 days. You need to do an elevator pitch. Now, if these guys at the lecture would have started by saying in 2-3 minutes, this is what we do. Now let's dive into this. None of those families would have left the room.
Denny, you make a great point, and a perfect example of this is I was giving a keynote. I believe it was at Harvard, and a couple people came up to me after I spoke, and they didn't tell me that was brilliant, or you told me some great ideas, or the insight was phenomenal. What they said to me, I didn't even take it as a compliment to start, but upon reflection, it really is a differentiator. And what they said to me was, that talk was really authentic. So I didn't talk about, yeah, I've done fairly well and I've made good investments, but I also screwed up and made mistakes and talked about that. If people could see that you're real and people could see that you're authentic, they want to work with you. I mean, look, we've got this, I run a couple Tiger 21 groups, and in my group, I have the picture of the iceberg. So you have the 5% where people see, oh, you live in a nice house, you travel well, you belong to the country club, et cetera. But what they don't see is the 95% underneath. The 95% where sleepless nights, the stress of being an entrepreneur, all of these different things. It's the stuff under the 95%, under the iceberg, that you really have to focus on. And authenticity, I believe, again, it's hard to say, yes, this person was authentic, or no, this person. You kind of get a sense of who is authentic once they feel that you're authentic, and you're going to be wrong. But if you're wrong, I was wrong because this is my thesis was this, and this happened, and this is why I was wrong. Authenticity is something, and vulnerability is another thing. Because again, look, we're all human. We're all in this together. And people don't understand. You leave the door, you don't want to just walk around like this perfectly polished person that, is brilliant. And because you're not. No, nobody is. We're all human. And if you could connect with people on the relationship, on the point of vulnerability, on the point of authenticity, you're going to do really well. How long? I can't tell you. I could just tell you that if you ask me what is a secret sauce, it's not really a secret sauce. It's being vulnerable, being authentic, having the alignment of interest correct, showing that you care by demonstrating that you care, and going above and beyond. Once you do that, which doesn't add anything to the bottom line of what I do or what many people do, everything will come in spades, because people know that you care.
My next point would be, and I have many points, we'll not be able to do all of them today, but exciting speaker. Okay. Many times I see that the person that's on stage is the actual entrepreneur. He has social capabilities of building. And and many times I'm thinking, this guy should not leave the basement. He should continue to do his research and do his thing, or her doing her thing. Do not communicate with people. You're not good at that. You are boring people that are listening to you. You're not. Bring somebody who can do the talk. So it's important to understand that sometimes the person that needs to do the talking is the right person. And sometimes, by the way, if somebody doesn't know how to present nicely, he can be interviewed. There's many ways around that. But when you're presenting to a family, don't forget, that's, I think, important in everything, but you need to excite people, tell them your story. And another thing I would mention, sometimes you see funds or companies being too technical. Don't forget, you're not talking to a VC that does communication. If you're a communication company, which understand or healthcare, try to explain it also in a way that people that are not experts can understand and say, wow, these guys are onto something. You know what? I'll bring my experts now. We'll check these guys out and maybe we'll invest with them. So don't be too technical. So don't send the wrong person to speak. And then when you do the speech, excite. Tell them the story. Why is it amazing? Why you found an interesting problem and you know how to solve it right? Why is the fund? You got yourself that niche that does so great beyond your ROI. So that's something I think very, very basic that I would like to mention.
Denny, I'm looking at the questions, and one of the questions was, in your experience, what are family office appetite for indirect real estate allocations or investing directly in real estate funds? Right now it's interesting with family offices. The buzzword right now is direct investments. They want to do direct investments. Why? Well, the rationale in most instances is flawed. I don't want to pay the 220. If I've got a heart problem, I'm not going to go to a doctor who's cheap. I'm going to go to the best doctor, and I'm not going to look at the price, right? So people want to save money on 220, and that's fine. There's nothing inherently wrong with that, but that's not why you do direct investment. And a lot of these people have done these direct investments. And as I said, we've had huge tailwinds in the last post-crash pre-COVID. And when I ran my hedge fund in the 1990s, I was smart enough to know that I wasn't that smart. In other words, from 1990 to 2000, it wasn't that complicated to make money. And we had tailwinds. Had I run my hedge fund in 2008, 2009, I'd have gotten killed. Now, I'm just being candid. This is true. But a lot of people let their egos get in the way. And with family offices, a lot of times you're dealing with people who've done extraordinarily well, and that's terrific. They've got very big egos, but the ego sometimes is actually, it's an advantage, but sometimes the biggest competitor for people. Because yes, you scale this company to $1 billion, and almost nobody in the world could do what you did, but now you're in a different skill set. So you have to take your ego and basically say, I'm going to surround myself with people that are smarter than me in A, B, C, and D. My dad told me, he was a brilliant banker. One of the things he told me, and I remember it resonated really well with me, was that when you go into a room, and he ran a large bank, he said, I could tell right away who the lawyers are, because the lawyers are always there trying to show that they're the smartest person in the room. I could also tell who the entrepreneurs are, because the entrepreneurs are there. They're trying to find the smartest guy in the room. So, and sometimes they don't say anything. They're just quiet, but they're trying to listen and learn. And again, ego is a double-edged sword. So I think with family offices, again, we are at a tipping point with family offices. All the banks, the accounting firms, the law firms, the money managers, they all want to get in this family office world. Why? Well, that's where all the money is. But all the money is a place where the people who made the money don't really trust traditional Wall Street. And Wall Street's trying to get into this space, but it's going to be very, very hard for them, because a lot of the reason they got into the space was to get out of Wall Street. So I can't emphasize enough the fact that trust, and authenticity, and the fact that you care about doing what's right and alignment of interest, that transcends every investment stat you could throw at them.
Thank you. I want to mention another interesting point about families. Unlike, and again, there are many points, we'll need to do it at a different session, but many times when you think about them, they have issues that they care about that I think the professional investors like institutional wouldn't. Impact investing, social good, things that you might have and you don't stress enough.
Well, again, that's a great point with impact investing, because my old self, which thought I was smarter than I really was, I would have said impact investing makes no sense. You basically invest in how you can create alpha, and then with the other part, you invest in philanthropy. And I would have told you 20 years ago, it does not make sense. I'm 20 years older, maybe a little bit wiser, and impact investing does make sense, and it does work. And remember, a third of the family offices right now do impact investing. It'll be about 50% in the next 3 to 5 years. And this is driven primarily by the millennials, rather the younger generation up. So I have a can here. I never looked at the back when I was growing up. I never looked at the back of a can to see who made it, how is it made, did they treat their people nicely, did they pollute? It wasn't that I was a bad person. I just didn't have this thing called the internet to get the information. Now, when my 17 and 20-year-old daughters, who are beautiful daughters, when they want to buy clothes or they want to buy food, the first thing they do is look at the back of this thing. And that's something that's completely different. So, if you look at what the internet and technology and with family offices, you didn't have to wait 3 generations to create huge amounts of wealth. With the internet and with technology, you can create wealth literally almost overnight. And there's people who've created billions of dollars because of the technology. If you look at it, if you go back all the way to the Industrial Revolution, I would argue, so I'm 57. When I went to college, I went to Northwestern. I had a typewriter, a Smith Corona typewriter. It was a good one because I had the whiteout key. It was like a round thing, and I was kind of cool because not many people had that. We had a computer lab where people went into. If that's 30 years ago, that's not that long time. That's not that long ago. If you look at the difference between my generation and my children's generation, I would argue that there is a bigger difference in light and how we live than any generation going back into, including the Industrial Revolution. Because right now, kids, this is going to be the new smoking, right? My kid sprained her wrist holding this phone. We have so much information and so much technology coming at us. And, family offices, what they're looking for is they just want to know, you don't always have to be right, but they just need to know that you're telling them the truth. And you see all this social media, I think the social media, it's another conversation, but the phone is going to be the new smoking. It's going to be smoking for this generation because it's horrible. It's great for us because we can do business wherever we want, but it's also other things. But again, family offices, it's holistic. These are people, these are companies, and they're people with a soul, and they do care. And the younger generation cares a lot more. Well, I'm generalizing, but they care more in general than the older generation because that's how they were brought up. And this impact investing, philanthropy is a huge component for family offices. So if you want to work with a family office, find what their causes are, what philanthropies they're involved in, if they're involved in saving the climate or whatever it is. I mean, Stanford, we're putting together the first school in 70 years at Stanford is going to happen, and it's all on climate. It's all about impact investing, which 20 years ago, I would have said, that makes no sense. Today, they're spot on.
That's a great point. And what is important that you stress the emotional values that you might have, and you don't even think you need to stress them, right? You might say, how does it apply to us? We're a fund that doesn't do impact. Maybe you hire handicapped people. Maybe you're donating money in an interesting way, right? Maybe one of your chair folks out there is doing something that's very good for something. Because you see, the institutional investors, as far as I see them, and they're probably going to tell me, oh no, we're not like that. Yes, you are, unless you're in the Nordic countries, that they actually care and they will not invest in a great investment if it pollutes the ocean. They are fighting over ROI, period. They are in a battle. They need to win great results. Families might tell you know what, results, yeah. But you know what, if there's a good cause, I'm willing to even earn a little bit less as long as it's something that I believe in. I had a session that I did at the World, what was it? Healthcare conference. I was the only person there who didn't understand any of the topics of the other lectures. My point was to explain healthcare companies how to reach the family office world, which is what I'm doing right here. And what I explained to them, beyond the fact that you need to speak to them in an exciting way and tell them the nice story, was I brought them a company called Pluristem Pharmaceutical from Israel. And I brought an investor, and they're a publicly traded company that ended up investing, and I asked, why did you invest with them? You know why? He said, first, I was looking for a disease my wife had, and I found that they do, trying to solve it. But then I noticed every 10th employee is handicapped. And I said, these guys are amazing. And you know what else he did? He ended up on the board, and he brought a lot of his friends because he was so emotionally excited about them. You know what power that is when somebody feels that you're doing the right thing and he brings others? And I'm sure every fund, every company raising capital almost would have that angle that you may want to stress and you don't think about stressing it. You should, because here you're dealing with people that not only results drive them.
Right. And, you make a couple excellent points. And, when I look at this, I was doing a webinar a couple of days ago, and they said, what's your North Star? And, my North Star is having family offices solve real world problems. So what do I mean by that? So my father passed away, and I loved him more than anything. He was my best friend at 57, which is how old I am. He passed from prostate cancer. My first job was at Drexel Burnham. I worked with Michael Milken. When Michael Milken, went to jail, he developed prostate cancer. When he got out of jail, rather than throwing $100 million to the American Cancer Society, he built it like a fund, $1 million here, $3 million here, 7 here. And because of him, you and I, Denny, and all the male listeners, if we live long enough, will die with, but not of, prostate cancer. And then you look at another example with Bill Gates, with what he's done with the vaccines. So I'm not saying you can run a philanthropy exactly like a business, but if you take these business minds, you look at what Elon Musk has done, and you take these people and you try to solve some of the problems, whether it be climate or poverty or inequality or whatever the cause is, that's going to really solve it. And that's really what we're trying to do at Stanford is to create this where the family offices are really trying to, the family offices are the ones that could make the changes, right? If you want to change without Michael Milken, prostate cancer would still probably be a huge problem. Without Bill Gates, the vaccines, you could argue, probably wouldn't have been done as quickly or as effectively. So these family offices have phenomenal power because they've got the resources to do it, but they've also got the entrepreneurial spirit. So my North Star is, let's put this entrepreneurial spirit into solving some of these problems that corporations who are compensated to earn money every quarter, they look at things more from a bottom line. And there's nothing wrong with that, because if you're the CEO of a corporation, you're supposed to make as much money you can for your shareholders. But I think when you transcend everything, the big world problems, the solution is going to come from the families. And that's what really excites me right now.
Thank you. I want to mention another point, which we talked about a little bit. Don't oversell yourself. And here I wanted to tell you a couple of things. I don't see it a lot with funds. I see it with companies. Sometimes you see those, it could be a blockchain company, and the CEO is so sure he's the best that ever happened to the world and to his family and to his industry because he's so amazing. Don't forget that family offices have seen it all. And when I say seen it all, I'm telling you, they also saw Hamilton even before it was out, even before, what's his name? I had a chance to watch it. They've seen it all. Everybody are knocking on the doors. They've seen people like you. They probably succeeded more than you. Take it easy. Don't brag too much. Show them that you're smart. Show them that you're modest. Show them that you're sophisticated in getting to where you want. Don't oversell yourself, which is what Ron mentioned before about being sick and tired of Wall Street. The Wall Street kind of over marketing would help. Again, if I'll take the blockchain example, your overkill marketing approach would work on the masses. When you're selling to, pardon my French, stupid people that follow trends and excitement, yeah, you can excite them. But when it comes to family offices, they are sophisticated people. They didn't get here because they're stupid, okay? They know, and I have a lot of points of how to, you need to be prepared.
Denny, you raise an interesting point. Yes, they are sophisticated people. There's no question about that. There's zero question that these people are sophisticated. But remember, they made their money in a specific niche, right? And they've got when they hear ideas, they've got one hand on their ear and one hand on their wallet, because everyone wants to get in there. Right? Once you sell your company for $1 billion or whatever it is, it's public knowledge. People know it's public. People know about it. And all of a sudden, people are going to want to talk to you. And at the end, they have an agenda. They want to sell you insurance, or they want to sell you their real estate fund or their private equity fund. I think by being authentic, and again, there's nothing wrong with wanting to do business with somebody who just sold the company for $1 billion. There's zero wrong with it. That's what you should do. but you have to demonstrate to this person that you're not looking for a transaction. You're looking for a relationship. And I would say that the key, any modicum of success that I've had throughout my career, the one, when I speak at some of these schools and talk to the kids, and these kids, I teach at Stanford, every one of these kids is probably a standard deviation smarter than I am. I've got a little more experience, but these are brilliant kids. And what I say to them is the most important thing right now in life is going to be, it's all about relationships. They did a study, I watched the TED Talks a lot, and they did a study, it was fascinating. It was the longest study ever done on happiness. And what they did is they took 80 kids who went to Harvard University and 80 kids who were the poorest people at Harvard. And this is like 1910. And they followed them. They've been following these for almost 100 years. So this study still exists. And some of these people went from the elites to poverty and suicide. And some of the people went from the very, very bottom and worked their way up. And what they found was the key to happiness and the key to success, the one variable, it's relationships. It's having the relationships. It's comforting and it makes a difference. And if you look at what people are looking to do, the families are going to surround themselves not necessarily with the best person in the world to do something, but with the people they trust. Because if they trust them implicitly, they're never second guessing anything. And I would rather work with somebody that I trust than the most brilliant person in the world that I kind of trust, but I don't know as well. And I can't emphasize that enough right now.
Ron, we should talk about it. I'm actually working on a very interesting, I don't want to say club, it sounds redundant, but a group of people with a certain amount of wealth that we meet because we're in Canada, in the US, in Israel, in the UAE, in interesting places that all share the same challenges and would happily invest with one another if only they knew one another. And it's not a tiger model, it's a different thing. We should talk about it. And here I just mentioned it so people would know that we're getting to an interesting area there. But I want to mention, and maybe Ron, you can take a look at the questions because we have loads of remarks here. You wouldn't believe how many people are reacting here. And I don't really have the time to read it. I was listening to you. Maybe you could take a look.
This is your show. Why do I have to do all the work?
You see, and you'll be involved at a Chicago event as well. So I have a lot of points, and we just talked about some of them today, which I think are very interesting because I really want you to get with understanding, points of do's and don'ts and how to reach the family offices, where to find them. We didn't even talk about that. How you find them. We'll talk about that in the next session. I want to bring one last point, and then I'll see if we have any last questions, and we'll just reconvene at our next session. My next point is, do not suck. Now, by that, I mean this. When you're looking, if your company, and again, I don't want to say blockchain again, or, there's a guy that came to me and said, oh, you know what, I didn't manage to sell anything to the family offices. I'm going to the money show in Vegas. There we're selling it like crazy. Well, there you sell it crazy because he's talking to people who don't have the tools to do the right due diligence and they're not experienced, and you get along. My point is, if your company, if you know what you're doing is not serious, right? If you're in any area, I don't want to say again blockchain but I've seen so many ridiculous groups from that area, right? There are some great, but there are some that you read the white paper and you're like, who's going to touch this? If you know what you're doing is a little bit off, and you're just trying to bring, get some money to get along, don't even go there. You'll be eaten alive. They will fry you like, don't waste money on sponsorships on us, because they do know how to do diligence. They do know how to tell if you're a real, to some extent, if you're experienced or is it just a show just to raise money. If you don't got a good thing going, don't even try. These are sophisticated folks. Go elsewhere, I just heard, Ron, that if you go to those platforms, the crowdfunding platform, that companies are paying, I want you to sit, but you're already sitting, over 11%, even more, when you take everything in order to raise money there.
Right. And
It's
that's
crazy. Now, I just want to say this, Ron. It doesn't mean it's a bad platform, because for some, that's the only way to go in the beginning. VCs don't look at them, this and that. But for many, they go there because they don't have any other way to raise money, because the sophisticated guys will not touch them. And I just want to say it very gently, it is in a way, you need to have a good product if you're coming to the family office space. That's what I'm trying to say.
And that's a good point. And again, working with family offices, one of the family offices that I started working with maybe 7 years ago, I was riding up in an elevator with a family office that I currently work with, and also a family office that I didn't even know they were a family. I didn't even know who they were. And there was the janitor also for the building who was on the call, who was on the elevator too. And I was talking to the janitor, just seeing what his family was, what's going on with his life. And because, I saw him almost every day, and I was talking to him. And when I got off the elevator, the guy from the family office that I didn't know knew the other family office that I didn't know, and said, I want to meet that person. And I'm like, whatever, who it is. And then he called me into his office a couple of days ago, and he said, the fact that you spent 45 seconds or a minute and a half in an elevator with two really wealthy people, and you were just focusing on talking to the janitor about how his kids were, I want to figure out how we could do business. Again, I didn't have an agenda. My agenda was not to show that I have empathy. It's just that I was being authentic. I cared about how that person's family was doing, because I knew they were going through issues. So, things like, empathy right now in vulnerability. Brene Brown has one of the most popular TED Talks ever is about vulnerability and empathy. And these are things that you need. I mean, we just had 4 years, and I'm not going to get political, but we had 4 years where we had a leader who didn't have empathy, didn't have the ability to have empathy. We need, as people and as family offices, we need to be compassionate. We have the money, we have the funds, we can make a difference in the world, but in order to do that, our goals and objectives need to be aligned, and we need to be doing this for the right reasons. And family offices, again, they're just people. They're just like, I was talking to somebody like, I can't believe you're talking to so-and-so. I'm like, he's just a person. He did really well in this. He picked a stock that whatever. Bottom line is, we're all in this together. And when people have that mindset or the attitude that I'm not looking at this as, you have this hole here and like, I'm only going to look out for myself. And then the hole gets a little bigger. I'll look out for myself and my kids and wife, and then a little bigger, maybe my extended family. But the larger it gets, and you can get to, I'm not at the point in life where I'm enlightened, I'm trying to get there, but you get to the point where everything kind of connects. That's ultimately where you want to be. In these family offices, again, it's these soft skills. That's the reason that the family offices right now, the model doesn't work. And when family offices start to realize that the governance, the succession, the next gen, the impact investing, the philanthropy are as, if not more important than creating alpha in a venture or private equity or real estate deal, we'll turn the corner. But we are getting there. We're getting close. We're getting very close. And again, it's just, we are at a tipping point right now. And I can't tell you how excited I am. And I'll tell you one quick story. When I got a job out of college, I got a job at Drexel Burnham, which at the time was like Goldman Sachs on steroids. And my dad said, he was a banker, and it was 1987. And he said, I want you to meet this guy who's doing this thing called private equity. I didn't know, it was a new industry. I said, Dad, I already got a job at Drexel. Why would I do it? 2 years later, Drexel implodes. The guy was a founder of Madison Dearborn, which became one of the largest private equity firms. And I wouldn't even meet with the guy because, so the point that I make is that I always said that, it was such a stupid thing on my part not to listen to my dad, and listening is the best thing that we can do to learn. Because when a lot of times we're looking to talk and figuring out ways to what we're going to say before we truly listen to what they said. Had I truly listened to what my dad said, he was IQ-wise genius, I probably would have gone into that. So the other thing I would say with people is, when you're talking to family offices, listening is a skill set but not just listening and then thinking, what am I going to say after he asks this question and how am I going to position this? Actually listening. It's not, people don't teach it. And I guarantee you everyone on this call or the people watching it live or watch it recorded has people that they love to talk to that are just great listeners. They just listen and they're empathetic. And that makes a huge difference. Family offices don't want people to talk about how brilliant they are. They can look that up and they can find that out and they can find your track record. That's easy. They just want people who listen, because if you listen carefully, you realize, why does this family office exist? Like, why are they doing it? And maybe they're creating it for different reasons and everyone has a different agenda. So my goals and objectives and your goals and objectives are different than a certain family office's goals and objectives. We have to listen to these people, but truly listen. And if you do listen, it makes a huge difference. Again, not prophetic, but obvious, but it makes a huge difference. Just talk less, listen more.
Thanks, Ron. And what we're going to do now is, first of all, as I said, we're going to do another session where I will continue with more points. We just spoke about maybe a fourth of the points that I wanted to get away. I will quickly go over the questions now. Okay. We have loads of them. Some of them Ron addressed. I joined late, so you may have.
You're deciding to do your job now and not me.
Finally, I'm reading. Yeah. How does one know what is a family office if they are prospecting? Generally, there isn't a website that says XYZ family office website. How do you find family offices? Ron mentioned before exactly that.
Well, the answer is simple. You don't, because there's a lot of people who tell you they're family office and they're not.
There are some groups. I would say, if somebody asking me why I ended up doing what I do, I have no idea. Bad mistake, but I do what I do, and I happen to be, I guess, good at that. And we do it because it's a very, very, a tough world where I am, going conferences all around the world, sleeping at great hotels and enjoying. No, but really, it's a lot of work. But that's exactly because of what you said. There aren't too many places you can meet family offices. What are you going to do? You're going to put an advertising at the family at the Wall Street Journal or at a billboard, or what are you going to do? So that's exactly the point.
No, and that's a great point, because family offices deliberately want to stay under the radar. Most of them, not all of them, but many of them want to stay under the radar. So how do you find them? And that's all we're trying to do. So, I basically use the analogy, the rich people need to find the smart people and the smart people need to find the rich people. In other words, the entrepreneurs don't know how to find the family offices, and the family offices don't necessarily, not all of them, some do, but don't know how to find the smart people. So how do you do that? And once we come together as a collective and we get together as a group, as an industry, I think it's gonna snowball. It's gonna expand exponentially, because objectively it is a superior model. Objectively, in many instances, if you're looking for something long term. Again, to flip a company short term, go to a private equity venture capital firm. I saw so many deals last year where I was just sitting outside and we were going to buy a company, and we just watched these private equity and venture capital firms pay absurd amounts of money. And even the founders of those companies would tell me, some of them I knew, they paid me money. I didn't even want to sell the company. It was just stupid money that they paid. They have to deploy that capital. Yeah. And with the amount of money they've got, again, it all goes back to alignment of interest.
And what I want to say to this anonymous attendee, that's exactly what we do, right? So you see groups that call themselves family office, this or that, and they would bring second, third, fourth tier deals one after another to families. And this is another discussion, as I said, how to find the family offices. But do you really think that a family office would look at those second, third tier deals one after another? No. What's happening is they're selling sponsorships for groups, but the people on the other side are not family offices. What we've done, though, when we build an event, as I said, we talk about everything that families care about, from depression to marrying wealth. And what does that mean? Things that you wouldn't believe people talk about. There's no media. We talk about things that makes them up at night. And then we get them close to us. And then when we have something interesting to offer, they listen. So
and you guys do. I've been to your conference before. I mean, you do a tremendous job at your conference,
Thank
and
you.
it's partly because when we did the conference at Stanford, again, I have zero interest in being in your business. It's a hard business putting together conferences. But what I said is, I went to Kirkland & Ellis and EY because we do a lot of work with both of those firms. At least in my opinion, Kirkland's probably the top law firm. It's arguable, but at least in my opinion, EY is certainly amongst, if not the best accounting firm for family offices. And I said to him, look, this is going to cost X number of dollars. I have zero interest in making $1 on this. You each pay half. And if you do that, I can get speakers that won't sell, but will actually try to educate. So when I go to these family office, many of these conferences, it's just people selling stuff under the guise of that they're educating. Now they are educating, and that's fine. And there's nothing wrong with trying, if you're good at trying to sell but it's not transparent, right? So it's what we did at Stanford. We had no clue. It was a virtual conference. We had it July 24th and 20, so like a month ago. I didn't know if I was going to get, and I told EY and Kirkland, I said, I have zero clue if I can get 5, 10, 20 people on this call. But I'm telling you this, there is a need to have a family office conference where Paul Carbone from the Pritzker family talks about direct investments, and he's not trying to sell a direct investment. Denise Illich from Little Caesars talks about philanthropy, and she's not trying to sell you to get into her philanthropy. Lauren Pressman from Eric Schmidt's family office, talks about real estate, and she's not trying to sell you her real estate fund. It's all educational. We had 850 families from 6 continents on that call, and it was virtual. And it wasn't because of me. It was because it was authentic. It was because it was transparent. And transparency is another thing that is so critical to everything, because we're all going to make mistakes. We just want to know, be transparent. Let us know what's going on. And once people understand that there is transparency, that's the reason the conference did so well.
Someone is writing here, thank you, Denny and Ron. There are people and groups out there going about claiming to be working with family offices and charging over 100K to make an introduction. I will tell you this, again, this is an entirely different discussion, and I can give you tips on how to understand you're dealing with people that are just, if you're lucky, are just doing a bad job. If you're theunlucky, fraud. But what I will tell you, there are things that you should figure out that, I don't know, maybe Ron, for you and I, it's obvious, and for others, it's not, but there's a, I will not mention, of course, any names, but you see, somebody's calling me and say, oh, there's this conference going on. That's the biggest conference in the world for family offices. It says so in their title. We're the biggest conference in the world for family offices. So one thing, I'm like, they write about themselves that they are the best. I mean, seriously? And you're managing people's money? And that's one point. Second point is, anybody who knows anything about the family office space knows that big is bad. Who wants big? Do you want to stand in a queue with 1,000 people? You want boutique. You want small. When you're a family office, you want to go to a place where nobody else goes to. So people that don't get that, at that basic level of understanding the basics of what you're dealing with, you know what? They deserve to go to those conferences. That's what I have to say on that remark right there.
No, I agree with you. And I think that when people, our job now with family offices is a job of education, because we've done the family office community, we haven't done a good job of it. But once we educate people about this, people will realize there is another, and again, remember, it's going to be larger than the entire private equity and venture capital industries combined. And when I talk to friends who are, really bright guys who are in private equity or venture capital or real estate, or they're lawyers or they're doctors, and they're like, what do you do? What's a family office? There is no right answer, right? And a lot of people, it's kind of shrouded in mystery, these family offices. But basically, a family office is just a person or people that are trying to live their lives and make their lives better for their family. And they just happen to have maybe 1 or 2 more zeros than everybody else. And because of that, it's not that they can't trust people in general, but there's so many people coming at them and they just want to make sure that the agenda, they wanted to go to the Cubs game because they wanted to hang out with me. Or they wanted to have a beer with me because they wanted to hang out with me, not because my ultimate goal was to sell them my private equity fund or my real estate fund. And the transparency is critical.
I will just say this. Actually, I have a call soon with now that we got Levenfeld. I told you that Ron as our legal.
Rob Romanoff is a good friend of mine, and he's brilliant.
So my next call is I will not say it here, but a very known CPA in Chicago that I hope will join us. This is how we build good events, by bringing the top names in every space. I will quickly go over the questions, and I will have both Ron and my information sent to you. So if you have more questions, you can ask us directly, because there's no time to cover everything, and it's been amazing. Somebody writes here, I'm a fourth generation family member making my livelihood in the oil and gas. He built companies himself. Now he's raising for his own thing. He has questions about who to go to financially, this and that. If we can help, shoot us an email. I'm sure Ron would have ideas. I can maybe have direct you in some areas. Quickly looking at more questions. Let's see. Is your experience, how often do family offices invest in indirect funds? Ron, any other question you would want to address?
No, there's a lot of, and look, I'm happy to, I like you and you do a great job, and I'm happy to, come and talk again. But look, at the end of the day, when you're meeting with, I was at one, this was when I was first starting in this industry. This is, maybe.
And maybe Ron afterwards just answer. There's one guy, one person, Brian, is asking what's the different skill sets of a CFO of a company and CFO of a family office. So maybe that one you can address as well.
Sure. Well, I'll answer that one first. They're two different skill sets. I mean, look at it. Private equity guys, when you come out, let's start with the premise that you're trying to make a lot of money when you're younger. Okay. And that's objective. Let's just say that's one of your goals. You're going to go into private equity or venture capital, hedge fund, real estate, because that's where you can make the money. There's a reason why private equity guys are paid the money that they're making, right? It doesn't mean that the CFO for a manufacturing company for a family can't transition and become the private equity guy, but in almost all instances they can't. You need to hire for that. Now that person may be really good, and you want to keep that person because they've worked for you for 20 years and you trust them, and you can't put a dollar price on trust. But they're not the ones that they don't have the skill set to be the ones picking the individual deals. There is this whole skill set to do this. And more people are realizing that the way their family office is structured needs to be tweaked and changed. And that's one of the things we're hoping to change, as far as helping people figure out how do family offices really structure in the right way and make it last, where 25% of family, only 25 to the second, 10 to the third, 5 to the fourth, those numbers don't work, and that's not sustainable. And what is sustainable is helping with these soft skills, helping with communication, putting together a community, and putting together transparency and authenticity. And when you do that, one of the family offices I was at 10 years ago, this was probably a $20 billion family, and I wanted them, because they invest a lot in a lot of the things that I invested in. So from selfishly, I wanted to have them work alongside me because I could deploy a lot more capital. And they said, what's the most important thing to you? And just without even my daughters and my wife and my family. And what they said to me was, that's the first time, everybody else that they've talked to would say creating alpha, diligence, this and that. I just said, this is what the most important thing to me is. And I ended up working with that person. But I think people, we try to oversell ourselves. I mean, intelligence is a commodity, integrity is not. And people could see through that. There's a lot of really smart people, a lot. When I was younger, I always was, fat. I wanted to work with this genius. Again, intelligence is a commodity, but the integrity and the authenticity of people is not a commodity. And that's really what we need to look for.
So thank you, Ron. Someone is asking here if we can share today's presentation. So again, not again, actually, 24 hours after the session, our system will automatically send you all the contact information and the recorded session that you can check on YouTube. We also send it to those of you who couldn't make it today. but you don't know it because you're not here, but you will get that email, you know it later. So thank you, Tammy, for asking that. Tammy, you've just witnessed the first session that I'm aware of that explains very thoroughly how to reach the family office space and how to understand their mindset. And again, when I say family office, I would say and high net worth individuals, not just family offices. And we have more questions. We will do several more of those sessions. This is the first one. We have many more points to cover. Tomorrow, Ron, just so you know, we're doing the first dinner, live in-person dinner in New York City after 2 years of not doing any private dinners. October 27th, we're doing our conference at the World Trade Center. We moved it from the Union League Club so it will be safe. We have Valerie Rockefeller. We have Dottie Herman, the legendary CEO of Douglas Elliman, probably the wealthiest self-made woman in real estate, and many more exciting speakers, October 27th in New York City. Then in November, we're doing our London conference with Sherry Blair in London. In mid-November, we have 3 conferences in Vancouver, Montreal, Toronto in 2 weeks. And then we, as always, finish the year November 30th at Art Basel, hopefully, finally, in Miami Beach. And and October 5th, actually, our next main event is our Canadian Family Office Conference. Amazing speakers. I don't know even when to start, from the founder of Second Cup, which is Canada's Starbucks, to amazing entrepreneurs and some of the biggest families in Canada today. Thank you so much, Ron, for being with me. And again, I want to tell you, Ron, you agreed with every point, and I agreed with every point that you made, but we didn't know what we're going to say. You had no idea what I was going to say, and you're not just being nice to me.
No, I thought you were also going to do your job and read the questions, and then you threw that on me.
And wait till you see when we will start to work on the Chicago conference. You'll be like, "Wait, I'm working for these guys somehow. What's going on here?" No, but I'm sure once we hit the road, you will love it. You'll see how
you do it, Denny. You do a great job, and I'm happy to help in any small way that I can.
Ron, thank you so much, and thank you everybody for joining us. We will be back. We'll update you with our next session and take it from where we left. Thank you. Stay safe and get ready for school for those of you who have 5 kids running around the house like I do. Thank you. Bye-bye.
Thank you. Thanks, Denny.